Most people think that dividend stocks that pay 3 to 4% are good enough for monthly income. But what if I told you that you can make almost $2,000 every month from just 3 ETFs? Because that's exactly what I'm doing. I found 3 ETFs that pay 14%, 16%, and 50% every year, and they pay you every single month. So in this video, I'll be showing you the exact plan that makes almost $2,000 monthly from these ETFs. And the first ETF in my plan is UMAX, which stands for the Hamilton Utilities Yield Maximizer ETF. And this pays 14.35% every year and owns the biggest utility companies in Canada. These are power companies, phone companies, and pipeline companies that people need no matter what happens to the economy. But here's the cool part. UMAX doesn't just own these stocks, it also sells something called covered calls. Think of it like this. You own a house and you rent it out, but you also charge extra for parking. UMAX owns stocks and gets paid twice. First from dividends, which is when companies share their profits with shareholders. Second is from selling covered calls, which is like selling permission for someone else to buy your stocks at a higher price. UMAX charges 0.65% per year in fees. That's called a management fee. Since it started in June 2023, people who put money in UMAX and kept all their payments inside made about 6% per year on average through inception. I put 50% of my money here. That's $50,000. This makes $7,175 per year, or $598 every month. The best part is getting paid monthly instead of every 3 months like most stocks. And really quick, I did notice that over 80% of people watching haven't subscribed. An easy way to help this channel for free is hitting the subscribe button, and I promise to keep making helpful videos like this. Second ETF is HHIS, which stands for Harvest Diversified High Income Shares ETF. This pays about 16.31% every year. This fund owns a bunch of other Harvest ETFs that each focus on one single stock, like Nvidia, Tesla, and Palantir. These are the hottest growth companies that everyone wishes they bought earlier. Each of these single stock ETFs uses covered call strategies to generate huge monthly income. The fund also uses 25% leverage, which means they borrow money to buy more stocks and amplify the returns. And it's important to note, while leverage can make your gains bigger, it also makes your losses bigger if things go wrong. HHIS charges 0% in management fees, but that's because the fees are built into the underlying ETFs it owns. And since it started in January 2025, it's still too new to have a long-term performance data. And after speaking with Adriano at Passive Income Investing on a recent podcast episode, I put 25% of my money here. That's $25,000. This makes $4,078 per year, or $340 every month. What makes this special is you get exposure to the hottest growth stocks while still getting steady monthly income from covered calls. And I have to mention, don't do what I am doing. This $100,000 is money I'm not using for growth investing. It's basically my emergency fund. I need this money to stay liquid, which means I can get it quickly if needed. So it was either this or a GIC or high interest savings account. And I usually tell people to use this strategy only if they're retired, not if they have more than 10 years before they need the money. Now, here's the heavy hitter, the third one, MSTE, which stands for Harvest MicroStrategy Enhanced High Income Shares ETF. This pays 50.29% every year. This fund focuses on one company, MicroStrategy, which is basically a Bitcoin treasury company that's been buying Bitcoin like crazy. MicroStrategy is a software company that decided to put most of their money into Bitcoin instead of cash. So when Bitcoin goes up, MicroStrategy stock goes way up, and when Bitcoin goes down, MicroStrategy stock goes way down. The fund uses covered call strategies on this one stock to generate massive monthly payments. It also uses 25% leverage to amplify the returns. MSTE charges 0% in management fees. It started in March 2025, so it's also very new without long-term performance data. I put 25% of my money here. That's $25,000. This makes $12,573 per year, or $1,048 every month from just this one investment. This uses covered call strategies, but on a stock that moves with Bitcoin's crazy ups and crazy downs. So this isn't your grandfather's dividend stock. This can go up and down a lot because MicroStrategy moves like Bitcoin. But when Bitcoin is jumping around a lot, the covered call premiums are higher, which is why the payout is so attractive. And a premium is the money you get for selling covered calls. So total across all three is $1,985 every month, which isn't bad. And what I'm doing is I'm putting all these monthly payments back into the same mix of ETFs. And I'll use this as a test case to see how it does compared to my regular growth portfolio that mostly owns VFV. And VFV is the Vanguard S&P 500 ETF, which just follows the 500 biggest American companies. And remember, if you want to calculate how much you can make, check out my free investment profit calculator in the description or first pinned comment. And it's also important to note that not all these monthly payments are regular dividends, and that changes how much tax you pay. Many covered call ETFs pay something called a return of capital as part of their monthly payments. This doesn't get taxed right away. Instead, it lowers your cost basis in the ETF. Your cost basis is what you originally paid for it. It sounds great, right? But here's the catch. When you sell later, you have bigger capital gains because your cost basis is lower. Capital gains are the profits you make when you sell something for more than what you paid. So for TFSA investors, this doesn't matter since everything grows tax-free anyways, and a TFSA is a tax-free savings account where Canadians can invest money and never pay taxes on gains. But if you're holding these in a regular taxable account, you need to track this carefully. The ETF companies send you tax papers every year showing the breakdown, but many people don't realize they need to adjust their cost basis. So think about putting these in your TFSA first, since the high payments are fully protected from tax. In an RRSP, which is the Registered Retirement Savings Plan, you get to delay paying taxes, but remember, you pay full income tax rates when you take the money out in retirement. All right, so you understand the ETFs and you know the risk, but how do you actually do this without making expensive mistakes? First, start smaller than you think. Don't put all $100,000 in on day one. Start with maybe $1,000 and then work your way up to $10,000 and get comfortable with the ups and downs and the monthly payments. You need to experience how these ETFs act during different market conditions. Second, set up automatic dividend reinvestment plans or DRIPs with your broker. A broker is the company you use to buy and sell investments. This automatically takes your monthly payments and buys more shares, which compounds your income over time, and most Canadian brokers offer this for free. Third is track your payments carefully, make a simple spreadsheet or use the investment profit calculator to watch your actual returns versus what you expected. These payouts can change based on market conditions and how well the fund managers can make money from covered calls. And here's a smart move most people miss. That's dollar cost average into these positions over 3 to 6 months instead of buying everything at once. Dollar cost averaging means buying a little bit at a time instead of all at once. So these ups and downs in these ETFs create more price swings. So averaging in helps smooth out the buying price. Now, let me be completely honest about when this strategy works great and when you should avoid it altogether. This isn't right for everyone. This strategy works best for people who already have a solid foundation of growth investments and want to add an income part. It's perfect for people getting close to retirement who need to shift from growing money to making income. It's also great for anyone with a time horizon under 10 years who wants cash flow now rather than waiting for long-term growth. Time horizon means how long you wait until you need the money. But here's when you should stay away. And if you're under 30 and have a long investment timeline, you're probably better off with broad market index funds that focus on growth. Index funds just follow a list of stocks like the S&P 500. If you're a conservative investor who can't handle ups and downs, these high yield ETFs will keep you up at night. And if you're looking for simple set it and forget it investing, this needs more watching than basic index investing. So the sweet spot is investors in their 40s, 50s, and 60s who want to start making meaningful passive income while still having some growth exposure. But even with these amazing payouts, you need to think about inflation's impact on your buying power over time. Inflation means things get more expensive every year, so your money buys less. If HHIS and MSTE pay 16 to 50%, but the actual value of the ETFs is only growing by 1 to 2% per year, while inflation runs at 3 to 4%, you're basically spending down your original money in real terms. This means you need to reinvest some of your monthly payments just to keep up with inflation. For example, on a $100,000 portfolio making $23,825 per year, if inflation is 3.5%, you should put about $3,500 of that income back in just to keep up with inflation. Your spendable income becomes closer to $20,325 or $1,694 monthly. This is still way higher than regular dividend stocks, but it is an important reality check. The key is finding the balance between taking income today and keeping your buying power for tomorrow. So the key takeaway is this: high yield ETFs can dramatically increase your passive income, but they're not magic. You're trading potential upside for immediate cash flow, and you need to understand exactly what you're buying. This strategy works incredibly well for the right investor at the right stage of their money journey. And remember, I'm going to reinvest all payments from this portfolio and track how it performs as a case study against my traditional VFV-based growth portfolio. So if you want to see updates on that, then make sure to subscribe, because this will give us real data on how income-focused strategies perform versus growth strategies over time. All right, check out these two videos for more investing tips. Bye, guys.